All right. So welcome to today's session. For those of you who have never met this Mwalimu, my name is Dr. Joshua Aura. I teach so many papers at RCM, but today I'm going to take you through audit and assurance. And I will start it very basic. Remember, this is my third session. Yeah. So it is lecture number 3, right? Appointment of an auditor, corporate governance, and what we call audit committee. Those are the 3 key things that I'll be covering in this particular session. Now, ladies and gentlemen, remember, when it comes to audit and assurance, an organization, I told you, whichever organization you work for, regardless of the size, it's important for you to work with a licensed auditor. So for example, today you have chosen that you would want to work with my auditing firm because I run an auditing firm that is Aura and Co, based at Havens Court, Westlands, right? So as an organization, what will be those procedures that you'll be using to talk to us, all right? So remember, we are normally appointed, ladies and gentlemen, by shareholders of your companies. So perhaps your shareholders of your companies will sit down in an annual general meeting, and then they pass a resolution that in the year that has just gone, would want, in this case here, for example, this and this, or in the coming year, would want this and these auditors to work with us. So the key thing, especially for firms that have been there for so long, anytime we talk of auditor's appointment, who does this appointment? It is the shareholders. I told you the concept of the 3 parties, if you remember, the 3 parties in the audit process. We must be having the users. In most cases, the users are the shareholders. So we have the shareholders, we have the preparers of the financial statements, who are the directors, and then we have the independent examiner, who is the auditor. I told you that. Yeah, so remember, who is preparing these financial statements? It is the directors. And I told you that these directors, because they have been chosen to oversee assets over a huge organization, chances are they may want to misappropriate those assets. And of course, theft. Like now what we are seeing happening all over globally in these countries. People are stealing left, right, and center. So then at the end of the day, these directors, they have to look at their performance and their position for the entire year. So they must prepare an income statement. They must prepare a statement of financial position, among other financial statements. When they prepare them, there is no way the shareholders will be able to accept them without an independent practitioner by the name of an auditor giving them assurance. So they would want, in this case here, this independent practitioner to look at these financial statements and in this case here, give their opinion as to whether those financial statements are good. If they are good, you shall be seeing later on in reporting, they shall be called unqualified audit opinion. So auditors will give unqualified, a good opinion. When they give a good opinion, then now the shareholders will have some kind of a comfort. That comfort is what we said is called assurance. So they'll be assured that, hey, those guys could be doing the right thing because in this case here, they have been told so by the auditors. So these auditors, we must ensure that they are really independent as we shareholders point to them. But we have said, I'm reiterating again, that these auditors shall be appointed by who? Shall be appointed by shareholders, those investors of these organizations. So you're reading here, ladies and gentlemen, and I'll be able to share this with you as we progress. So before an audit can begin, a client needs to appoint an auditor. But who is allowed to be an auditor? Is it just anybody? Can you wake up, for example, like now, most of you here are still students? No, there is a process to becoming an auditor. Auditor eligibility is extremely important. Not just anyone can be an auditor. You can't simply decide to call yourself an auditor. Every person who wants to practice as an auditor must meet minimum qualifications, and by and must be registered under an approved body. To be allowed to perform an external audit, an individual must go through an approval process. Now, the approval process depends on where you are practicing. Since this paper that I'm teaching is an ACCA paper, yeah, I'm only inviting you guys to come and join us, but of course the content is the same. Since this is an ACCA paper, the focus is on the United Kingdom. So in the United Kingdom, to be an auditor, you must be a registered member of ACCA. That is very, very important. You cannot be an auditor if you are not a chartered accountant. In Kenya, just like it is in the UK, in Kenya, our regulatory body is known as ISPAC. So upon you clearing your examinations, yeah, CPA, you have cleared your CPA, then you'll be able to apply to the Institute of Certified Public Accountants to be registered, first of all, as an ordinary member. So once you're registered as an ordinary member, if you'd want like a practicing license, like now the one that I hold, you must sit down with an existing auditor. Just the same case with the ACCA. You must have auditing experience. Once in this case you are able to finish your experience, then you apply to ISPAC or to ACCA again to get a practicing license. So two things, there is being an ordinary member of ACCA, and there is a acquiring of a practicing license to practice audit. So first of all, before you are appointed by any organization to be an auditor, you must be having the practicing license. So it's not that easy. You know, people think that becoming an auditor is just something that you finish your CPA, you finish your ACCA, and then boom, there you are. No, there is a process. You must work in a licensed auditing firm for a number of years before you get the required skills, the required experience to be admitted as now an auditor who is now a practicing member. All right. So if you're practicing outside the UK, say in Canada or the USA, you will need to be like in Kenya here, you will need to be a CPA. Regardless of the jurisdiction, you must be registered with the appropriate professional body. Likewise, if you are an auditor, you must not be a director or an employee of the client or of any associated company. Also, you must not be a business partner of the client. These are really, really very, very strict, ladies and gentlemen. If, for example, today I'm to be appointed to be the auditor of Safaricom, yeah, 𝐨𝐼R𝐟𝐞𝐬 is being appointed to be the auditor of Safaricom. Amen. May that come to pass. We are being told here the auditor must be an independent practitioner. So that it would mean that 𝐴URA will not be an employee of Safaricom. I mean, I must be really distant, far away from Safaricom, right? I should not be an employee or a director of Safaricom. I should not be working for any subsidiary. Yeah. Are you guys able to follow? Please give me a thumbs up. If you're able to follow, please give me a thumbs up. Yeah, great. So then I should not be an employee nor a director of an associated company of Safaricom. So for example, I should not be a director or an employee of a subsidiary. If Safaricom has a subsidiary or even associated companies, I should not really be an employee there. I should be, ladies and gentlemen, and that is why it is very, very important for you to work very hard as an auditing firm so that you don't get to work with so many things. All right? So, and remember, even shareholding, if I'm to be appointed as an auditor of Safaricom, I can't, for example, be having significant shares at Safaricom. If I have significant shares at Safaricom, then I will not be independent. You know, as you shall be seeing later on, ladies and gentlemen, at the end of the day, an auditor will be giving an opinion which will have an impact on the share price of this entity. So you can imagine when it comes now, I've been able to gather my evidence. I've gathered my evidence. Now I'm saying that Safaricom financial statements are not good. So I give what we call a qualified audit opinion. So if I give a qualified audit opinion, the stock exchange will be able to see danger ahead. When the stock exchange sees danger ahead, then the shareholders will not demand the shares of Safaricom. The share price will go down. So if I have interest in Safaricom, every time I'll be giving a good opinion, because if I give a good opinion, then I will be uplifting the share price of Safaricom. So I should not be a director, an employee of Safaricom, nor its associated companies. I should not have, in this case here, for example, my relatives like my wife working in those companies. They are very, very strict because really auditing is all about this concept of independence, because they are sending me out there to these particular directors to go and probe them, to go and use my audit methodologies to ensure that I collect sufficient, appropriate audit evidence and form a genuine opinion. So I can only form a genuine opinion if I'm independent. If I'm independent. All right? So likewise, if you are an auditor, you must not be a director or employee of the client or of any associated company. Also, you must not be a business partner of the client. These are very strict rules. So to summarize, you must be an ACCA or equivalent like CPA, etc. You must not be a director, employee, or associate of the client. You must not be a business partner of the client. If you meet all these, and of course, like the family conditions, then you are eligible to be an auditor, because now you'll be said to be independent. Auditor's appointment. Once you are eligible, how are you appointed? Shareholders, I told you, are responsible for appointing auditors. They choose the auditor and also decide on their remuneration, how much will the auditor be paid? So in the AGM, they'll be saying this coming year, we are going to work with 𝐂𝐼RA and core. And once we pick 𝐂𝐼RA and core, then how much will we be able to do what yet to pay them? So the AGM, the shareholders will be able to decide on the payment. We don't want to leave this thing of the remuneration of the auditor to the directors. If we leave the remuneration of the auditors to the directors, then the directors will be telling these auditors, can you kneel down? If you want more remuneration, if you want a higher pay, can you do this and this? We shall compromise the independence of the auditor. Ladies and gentlemen, money is sweet. Money is good. If as an auditor, I'm told in this case here now, go to this particular government ministry, start auditing them, and then I realize that the people that I'm auditing are the ones in this case here who are holding on to what I will earn, then it is so unfortunate, because we can easily be tempted to take their instructions. I would want to be as independent as possible. So let the AGM that is appointing me, the annual general meeting of shareholders that is appointing me, let it be the one making a decision like how much shall I be paid as an auditor? So shareholders are responsible for appointing auditors. They choose their auditor and also decide on the remuneration, how much the auditor will be paid. Once shareholders have decided to appoint you, they will contact you and make the offer. Now the question becomes, should you accept the offer? Now, ladies and gentlemen, there are some auditors in this case here, whenever they are given a chance, somebody just gets across to them, tells them, in this case here, we are this bank and would want you to audit us. Like for example, at 𝐂𝐼RA and core, if I get any offer from any bank to audit them, I will faithfully decline. Why? Because we do not have the capacity. I don't have that experience. How much even audit fee should I be able to charge in that situation? And I've never encountered myself, or I've never, had that experience before. So then you get somebody accepting, like Equity Bank has told me to audit them. They come in and, for example, they quote 20 million, not knowing that the scope of work, the amount of work you're going to do may very easily consume that 20 million and even more. So it's very important, ladies and gentlemen, whenever you're given an offer from an institution, for you to always ask yourself, do I have the capacity? Do I have the resources? Or the directors of that company, are they men and women of a high integrity? Because remember, just a simple blunder, and I've seen this happening, especially in Kenya, even in the UK, ladies and gentlemen, a small blunder, there is a client you can accept like this, and then you get yourself being snatched the audit license straight away. So you have to be very, very careful whenever you're choosing what here your clientele, all right? Like in our case here at Aura and Co, we try as much as possible to avoid like this high political octane, high octane political institutions. The only one that we have, which is really, I mean, respectable, is a KMPDU, the Kenya Medical Practitioners Dentist Union. We are the ones who are auditing them, and those, they are doctors. I mean, it's a union fine. Of course, they have their great politics, but it's calm. They are able to cooperate. All right. But most of the others, we tried one which I will not mention and regretted almost immediately. We're almost resigning in the middle of the game. Yeah. Why? Because you go to an organization, every time in this case, you're being told you can't do this, you can't do. No. So it is always important for you to know your strengths as an auditing firm before you carry out, before you sign the contract with this client that, hey, let me be your auditors. It's not about the fees you'll get only. There are so many risks around. So you must be able to do your background check. You must be able to do your due diligence for you to be able to set in your feet into an organization as an auditor. So now the question becomes, should you accept the offer? Just because a client offers you an audit engagement doesn't mean you must accept it. Auditors are bound by regulations and professional frameworks, such as international standards on auditing. We have our own framework that really regulate us. And there are steps you must follow before accepting an engagement. Step number one, client assessment and professional clearance. That is what we call group one activities. So the first group of activities include client assessment, professional clearance. These are crucial because if you accept the wrong client, you could lose your license. Client assessment. You are checking whether it is safe to work with a client. The probing questions to ask include, is it safe to audit this client? Do we have enough resources? What is the client's credit rating? Like outside there, the CRB is really, really big. Like in the UK, the US, yeah. You can easily, of course, in Africa, it even becomes a bit hard to get the credit rating of these people. Yeah, because I don't want, ladies and gentlemen, to get into an audit where I will not be paid at the end of the day. So what is the client's credit rating? Can they pay us? Will they be able to meet deadlines and provide necessary information? Do their directors and management have integrity? Or are they, in this case, involved with some scandals outside here? If they have some scandals outside here, for example, you're going to audit a land selling company, and then you hear that the CEO was in a company that collapsed. Please, as much as that audit exercise may look lucrative, run away from it. Integrity, yeah. Honesty is really a virtue that we look at as auditors. Are they involved in illegal activities like drug trafficking or money laundering? Yeah, we have to ask these kind of questions here. We must be able, ladies and gentlemen, to do lots of studies of the clients that we would want to onboard. We don't just onboard anybody. Actually, with the auditing, you would rather just grow slowly, organically. And the auditing, remember, like, for example, a school like RCM, we are able to market aggressively and we are able to get, in this case here, great numbers of students quite fast. This is the business model for the college. But when it comes, in this case here, to audit, you would rather onboard like 2 or 3 good clients on a yearly basis, just slowly like that. Yeah, after all, it's a business. If you run it very, very well, just with a lot of integrity also yourself as an auditor, it's something that you will not be able to retire from. It is something that you can easily work with. And of course, I mean, to the very late years here. So for us at 𝐴𝐼𝐸&CO, I mean, what are the key things? Because I must also give you my own experiences whenever it comes to acceptance of these audit engagements. So first, what I will do when I'm appointed, I would want to know very simple things. Whether, on top of the things that have been asked there, whether the directors understand their responsibilities and whether they know that they are the ones who are charged with the responsibility of preparing financial statements and the responsibility of instituting proper set of internal controls. So if I come to your organization and you're telling me, hey, auditors, and then I ask you, do you have an accounting system? Then you're told no. So you know straight away that the director's knowledge of their work is not very thorough. And if the directors do not know their work straight away, I would rather decline audit assignment. They would rather, in this case here, engage me to provide accountancy for them, because you also outsource. Many companies outside here outsource our accounting services at 𝐴𝐼𝐸&CO. I mean, when you go to a company that the directors don't understand their responsibilities, then automatically you as an auditor, you will really, really do some very, very shoddy or even bad work that will not be profitable at all because of what we call expectations gap. That you're getting into an organization, and then now people think that you as an auditor, you are the panacea of all their problems, that they would want you to handle their accountancy, do financial reporting for them. They would want you to handle their taxation. No, that one, trust you me, those are not good clients. So for me, on top of the things that you have read there, I would also want to work with directors who understand their responsibilities. And then, of course, now my role, if they've been able to do their financial statements very well, my role will be to come now and do what international standards on auditing need me to do. They need me to provide, to give an opinion as to whether the financial statements that the directors have produced portray a true and a fair view. I'll be explaining that later. So my role as an auditor, ladies and gentlemen, is to provide, that's my primary role. Even this one of detecting frauds and errors in the company, of course, I'll be able to put in checks and balances to detect them. But it is never my primary responsibility as the auditor. No. That is the role of the directors. Mine in this case here, should I come across them, then I'll be able to highlight them. All right? But it's never my primary duty. The jobs that we love, like 𝐴𝐼𝐸&CO is known for auditing hotels. Yeah, of course, we have other clients, but I mean, our biggest clientele are these big hotels like in Mombasa. Yeah, the 5 stars. We have about 4 of them. Yeah. So then in this case here, what we do, we like working with directors who are of a high integrity. Not people are trying to be dodgy, for example, over taxes. Yeah. And then number 2, we like working with directors who know their responsibilities. Their main responsibility, of course, they have, but to us, the most important responsibility is that they are keeping proper books of accounts and they are able to produce financial reports that faithfully represent their underlying transactions. And then, of course, they're able to keep proper internal controls to ensure that the assets of the firm are safeguarded and to ensure that the firm's longevity is not compromised. So, ladies and gentlemen, I think I'm talking too much, but somehow are we together? Because when I teach audit, I would want to teach people in a way that when they get outside there, they should be able to, I mean, be different. Yeah. Are we together, ladies and gentlemen, up to now? Are we together? Are you able to comment down there? All right. Thank you so much. Thank you so much. Thank you so much. Great. They're listening. They're listening. They're listening. All right. Then we have professional clearance. In most cases, in the companies that we find ourselves in, we may not be the first auditors. There must be, like the firms that we have had. I mean, we have never gotten a firm where we are the first auditors. No, no. Thank you so much, Maria. We have never gotten a firm where we are the first auditors. And perhaps in this case here, we may not be the very best choice for those firms because now our fees, because now we've been in the market for so long, our fees may be high for startups. All right. All right. So then, ladies and gentlemen, what we shall do under professional clearance, if this is Aura and Co, and this firm that you want to take to, not firm, but companies you want to take for auditing purposes was being audited initially by XYZ. I mean, we can't just brush shoulders on the corridors. This is an exiting auditor, outgoing auditor, and then coming without saying hi. It will be very important for us to seek permission from the hotel we are auditing to talk to the outgoing auditors before we accept the job. There are no auditors who leave assignments, good assignments, that easily. There must be a reason why these people are leaving the assignment. So some of the reasons could be very easy. For example, non-payment of audit fees. So non-payment of audit fees, what do we do? Me as an incoming auditor, it is duty bound. I'm duty bound to ensure that the outgoing auditor gets his fees in full before I accept the engagement. Yeah, I have to protect them. It's called professional clearance. I must get great reasons. I have to ask, why is it that you are leaving this company? Others will tell you, for example, now due to audit rotations, now in this case here, we have done 3 years, and now we have to give room to a new auditor. Great, professional clearance. So now I take up. Some auditor will tell you, ladies and gentlemen, that you know what? Those directors, I mean, are dubious. They're doing dubious things. Yeah, their integrity is questionable. Then I will not accept the engagement because professional clearance, once my colleague in the industry at ISPAC, at ACCA, an auditor, of course, we share the same umbrella. Then, ladies and gentlemen, if this person tells me that these people are bad, it's good I just trust them and tell the directors, hey, no. And of course, as I'm telling them no, I'll also hear their side of the story, right? I'll also hear their side of the story. It's always good to look at both sides of the coin, right? Now, what if when I'm requesting for permission from this hotel to talk to the outgoing auditors, the directors tell us, no, permission not granted? Then I'll also tell them, not a problem. I'm not accepting this engagement. You guys look for another auditor. They go to another auditor. They realize that, hey, it's like a standard across. So professional clearance, very, very important. So we are told here, professional clearance, this applies if you are not the first auditor, i.e. the client had a previous auditor. You must contact the previous auditor to ask why they left. Get clearance from them, but you must first obtain the client's consent due to confidentiality obligations. If the previous auditor reveals an ethical or criminal activity, you must not accept the engagement. If the client refuses to allow you to contact their previous auditor, you cannot take the job. So that's step number 1. Step number 2, agreeing to the terms and the conditions, what we call now group 2. Now we have been able to do a background search. We have had professional clearance, all right? Now we are into the second step where we are accepting now this job. So agreeing to the terms and conditions, group 2, activities. This is governed by ISA 210. Before accepting an engagement, you must confirm that preconditions for an audit exist. And you must sign this contract that I shall be calling an engagement letter. preconditions for an audit is that these directors have prepared financial statements in accordance with IFRS. I will ask, ladies and gentlemen, whether the directors have prepared their statements in accordance to our financial reporting framework, which is IFRS. If yes, well and good. If no, I will not accept. Not unless it's not within Kenya or within UK, because UK, it's, IFRS is they have been adopted by government. Yeah, it's like now going against the law. Management must acknowledge their responsibilities, which include management must acknowledge their response in writing. In this acknowledgement letter, in this engagement letter, the engagement letter, the management must acknowledge their response, that they're the ones who are charged with the responsibility of preparing financial statements, implementing internal controls, and that they shall be able to provide unrestricted access to information. Unrestricted access to information. And at times, companies are funny. We always find ourselves in this situation where, ladies and gentlemen, you have signed even an engagement letter. Directors have said, hey, when you come, we shall give you a 360 degrees view of our company from whichever corner. You want to access this information, we shall give it to you. You'd want, in this case here, for example, to access our board minutes, we shall give them to you. They will always say that. But when you start, in this case here, then auditing them, I mean, things change very fast. Like I told you of a school that we were auditing, I want to mention the name. All right. Where in this case here, you get here, you are told that, you know what, the documents you are asking for, they were in this room, and you can see even that room got burnt last year. So I can't get any information. At times you go and you had made arrangements here with the finance director and the other accountants, or even the chairman of the audit committee. You wanted a brief meeting with them. You go, yeah, and then these guys can't open doors for you. So it means that they are hindering my scope of operations. They're squeezing my existence there as an auditor. And remember, as an auditor, ladies and gentlemen, I'm supposed to be independent, and I'm supposed to be given any information that I need, because really my work is to provide an opinion depending on the evidence I collect. So the moment you start restricting my movements within the firm, you're telling me that now you said you want to get, in this case here, school bus parked somewhere for you to see it. We can't do that, because now this school bus, I mean, it is now fetching children. I'm not a young man. When I asked to see that bus day 1, I asked to see that bus day 2, day 3, in vain. I know straight away that that bus is in the books, but doesn't exist. You'd want to portray that your asset base is big, for maybe the bank, in this case here, to give you loans, etc., but that bus may not be, I mean, I just want to see that bus for less than an hour. All right. Why can't you just make arrangements, an alternative for that day? All right. So there are things, ladies and gentlemen, that we get to see outside here. I'm telling you, if, for example, today, and this is something that I always tell the responsible parties at ISPAC, if in this case here, auditing was to be strengthened, such that auditors are made to do their work, like now, of course, they try, but you see, we will still get somebody. I mean, I don't know whether these are auditors who are registered or what. Somebody in this case here, I mean, they want audited reports, blah, blah. Somebody just gives them a stamp. If auditors were to do their work correctly, I'm telling you, this industry of finance, this industry of CPA, ACCA will be very, very big. We shall be able to get very, very big jobs as CPAs, as ACCAs outside here. But unfortunately, we haven't really strengthened the accountability responsibility pillar in this country. If KRA was, for example, when somebody goes and then they say, for example, that my asset base is 380 million, they're always there on TV. It's like they're competing. Then somebody should be able to question, out of these 380, how much taxes have been paid at the back end? Yeah. Yeah, that way we'll be able to know the integrity. Then the accountant's value will go up. The accountant's value will go up. Those are the kind of things we'll be fighting for very soon, especially when I ask for chairmanship of ISPAC. Engagement letter. This is a contract between the auditor and the client that minimizes misunderstandings. It shall be able to clear those expectations gaps that the client expects you to do that and you're doing different. So this is a contract between the auditor and the client that minimizes misunderstandings, serves as a legal basis for fees, and the services must be signed by both parties. Minimum content of the engagement letter includes the objective and the scope of the audit, responsibilities of both the auditor and the management, the nature of audit work. I'll be explaining what this stands for. The substantive testing, control testing, etc. The nature of the audit work, this has to be really well put down. Fee arrangements, how much, and of course, by when. It's very important for us to know the exact amount and the timing. So like, for example, if it's a good hotel, we are auditing here, for example, we could quote something like, say, 600,000. Yeah, but of course, 600,000, if you're not careful, you may not make a profit as a firm. Because if this hotel is in Mombasa, there is flying to Mombasa. You're not going alone. You're going there with a team of, say, 2 or 3 people, because it's a big hotel. And that is why, in terms of fees, you must have a clause that talks about disbursements. We call them disbursements. That anything to do with, in this case here, when we go down there, transportation, food, etc., ladies and gentlemen, would expect in this case here to provide invoices, would expect to have a summary and then invoice for those things. Otherwise, out of the 600,000, then the audit firm will not be able to make any profit there. So disbursements must be there. So that clause of disbursements must be factored in the engagement letter, in the engagement letter. I have to explain something, ladies and gentlemen, here. When I say food, of course, we don't expect when we go to audit an hotel in Mombasa that our own staff shall start eating food in the hotel. We try to discourage. Later on, ladies and gentlemen, we shall be learning something to do with what here? Undue hostility. Undue hostility compromises the auditor's independence. Undue hostility. And again, this is something I even tell my colleagues at ISPAC when I'm training, because I'm also a trainer at ISPAC. An auditor, before you start going, in this case here, to some of these assignments here, you should eat properly. Don't go to these areas and then you're given like tea and no, just eat properly from wherever you are. Go there, in this case, even when you look at a cup of tea, at times you don't even take. Because truth be told, we are not, of course, we are supposed to be seen like we are collaborating with this organization to be able to ensure that the value of the firm goes up. But most organizations where we go, we are normally seen as enemies. They don't see them, they don't see as their partners in terms of the elevation of the business. They see as enemies. And that is why you should not be eating around. An auditor should just do the work and go. Yeah. You're not supposed to even to be mingling a lot with the staff members there. All right. Of course, it's allowed when this, for example, if the other employees are getting 1 cup of tea, 1 sauce, it's allowed, you can take. But what I try telling in this case, especially these young auditors who are joining the industry, no, if you have eaten very well in the morning, or you can even carry your own food. Those are simple things that you can afford. An auditor is paid well. Yeah. Yeah, because we don't want, in this case here, to be very familiar. Because once you get so much familiar with the client employees, because you're eating together with them, you are now getting, even being served, in this case, someone who keeps on serving you food every day for 2 weeks, you'll get used to them. Let them know that, these auditors, of course, we are friendly in our job, but we don't want, in this case here, anything that may make us to be very, very familiar with the employees of that company. It's called familiarity threat. When you get used to each other so much, then you will not be able to address them. You will not be able to come and say that, you know what, their financial statements are bad. You become friends. So fee arrangements, and then of course we have here the format of the audit report. We must tell them how the audit report will appear. These 5 items are mandatory. These 5 items are mandatory. You can add more, but this must be present. Then we go to what we call corporate governance. Under corporate governance, ladies and gentlemen, you know what is corporate governance, I believe. Everybody here must be knowing what corporate governance is, how we govern, how we manage corporations. So corporate governance basically gives us the rules of how organizations are supposed to be directed and controlled. So if it is Kenya, of course, we have our country's governance. We have the executive, we have a parliament, we have a judiciary. How do we direct and ensure that everything in the company runs well, harmoniously? That's what we call corporate governance. If corporate governance, ladies and gentlemen, in this case here, breaks, then automatically, the whole company will not be there in the future. The whole company may become what here? Bankrupt. Corporate governance is a serious thing. Under corporate governance, then we'll be required here to know what we call the 5 key pillars of corporate governance. So we are told as an auditor, you also need to understand corporate governance. This refers to how a company is directed and controlled. Companies with good corporate governance are usually better audit clients. Weak governance may indicate audit risk, and auditors may not recommend improvements. Corporate governance is mainly the responsibility of the board of directors, as shareholders are not involved in day-to-day management. Directors act as agents to move the company toward shareholders' goals. Corporate governance code. This is the most widely referred to in ACs. It's called the UK. Yeah, Code of Corporate Governance. Yeah, it applies globally. Yeah, it applies globally, especially in like UK. I mean, all over. It is structured around 5 key pillars. Number 1, we must have a board leadership. This pillar emphasizes the role of the directors in setting the company's business model and strategy, which provides direction to both the organization and its management. A clear mission and vision must be established to guide the company's operations. So pillar number 1. Remember, in a big house, we have the pillars. In a big building, we have a pillar, storied building. You have those pillars, the columns. If one column is weak, then the entire house will come down. So one of those pillars for any organization, we need an organization to have a strong board. Under this board leadership, you're saying that the board, to be able to lead, then you must be able to know the business model. So if it is RCM, our board should be able to understand that you are raising money through training. We are raising money through training. We are raising money through training. And therefore, it will be incumbent on them to ensure that they are thinking of like, how do we diversify our portfolio? Apart from ACCA, do we need to have other courses? And when we introduce these new courses, how do we promote them? So they need to craft what we call a strategic plan. All right. So basically, the board of directors, ladies and gentlemen, shall be able to ensure that they understand the business model very well, and then they are able to set a strategy. How do we reach there? How do we succeed? How do we reach what we call the blue ocean strategy? Remember, when you look at yonder in the oceans, you are able to see far away there the blue section. Under the blue section, if you look at that ocean down there, you'll see things there are very calm. But when you come closer to the shore here, I mean, there are many things happening, right? We have, in this case here, people who are swimming there. There could even be crocodiles. So this side, we normally call it the dirty part, the red ocean part. So on the red ocean, normally we shall be having so many competitors fighting for the same things. But as a company, as for example, RCM, if you work so hard and get far away into the blue ocean, there we don't have competitors. And we can only get into the blue ocean if we are very, very good in terms of what here, innovation. If you look at, for example, Kenya here, you'll realize that there are organizations like Safaricom, even when we were hit by COVID, their revenues remained almost the same. There are even some years of COVID when their revenues even went up. Why? It's because they are already at the blue ocean. And you can only get into the blue ocean if your leaders are able to set the right tone at the top. If the leaders are able to set the right tone at the top. At this juncture, I would want you to put your cameras on. Don't fear me. Somebody put your camera on. I've actually never seen your faces. Put your camera on. Put your camera on. Please try putting your camera on. Please try putting your camera on. Somebody put your camera on. Yeah, thank you so much, Geoffrey. Please put your cameras on. Today, I would want to see you guys. Put your cameras on. I would want like 20 people to put their cameras on. I'm so serious. I would want to see 20 people putting their cameras on. Thank you so much. I can see Chris there. Okay. I can see Catherine. So can you kindly, all of us who are putting on their cameras, can you kindly hold your chin? Please hold your chin like this. Please hold your chin. Thank you so much. Do you know that you guys, this is the chin? Do you know that the chin is here and not here? Are you aware? Are you aware that the chin is this one? We shall overcome. And I cannot blame you. Now you can put off your cameras. You can put off your cameras. Thank you so much. Now, why do you think these particular great people were able to hold this as the chin? It's because currently here, I'm privileged to be your leader. And as your leader, I've been able to touch this as my chin. So you are following my footsteps. So you're saying corporate governance, number one, it is the leaders that we have. The board must be able to know what really is needed. And then at the end of the day, once we know what is needed, we should be able to set the right strategies. If you look at most of these nations, especially in Africa, we don't have proper boards. And I'm normally apolitical. I don't like taking sides. You'll never hear me talking bad about anybody. But generally speaking, like since 1964, whatever, even guys who are in opposition, I think we do not really have a proper management at the top which understands like what is expected. And if they understand like what is expected, they do not know how do we reach there. You'll read very good manifestos. Like UDA manifesto, was very, very good. For example, they are talking over changing Mombasa to a free port. Good strategy that can bring in investors. And then once they bring in investors, our children here will be able to get jobs. But when they take over leadership, they start again campaigning throughout. Any company must have proper board leadership as a key pillar. Yeah, a board which understands the business. Not those directors. These are something I normally always look at. Whenever I'm auditing any company, I'll want to know how many directors we have. They tell me we have 7. Then I'll ask for the board minutes in attendance, and I will insist that I would want to know in this case here, these guys here, how many hours they attended their meetings. So some in this case here, you'll see some guy in this case here came at 4:30 and the meeting is ending at 5. So basically, this guy came to sign in so they can get what year he can get his allowances. Ladies and gentlemen, that is very, very bad. That shows what year lack of integrity. Yeah. So for example, like as RCM, you guys have never known, we work with very independent directors. People are coming with lots of experiences from outside. Yeah. We have a board member of 4, and I'm the chairman, right? Right. So it will be very, very important for us to do what here? Very, very important for us to ensure that we have a board which understands the business. And they are bringing, in this case here, so many, yeah. So board leadership. So a clear mission and vision must be established to guide the company's operations. Then we have board composition, evaluation, and succession. This addresses the structure. This is a very, very great pillar. Succession. Do you know, many companies are not able to work on succession plans very, very well. Just imagine Equity Bank without Mwangi. Disaster. So I don't think they have really worked very well on their succession strategy. By now they should have groomed somebody who is equally or a little bit lower, but strong. So that should something happen to him, I mean, whether we like it or not, this is a natural thing. We are becoming old. Day by day, we are becoming old. We will need to prepare people who would want to come and take over our businesses. And that is why, like myself, the moment I hit like 53, 54, 55, right, I need to start selling shares of RCM. All right. And if possible, God willing, we should be able, ladies and gentlemen, to list the college at the stock exchange. Yeah, so that you can be left with fewer shares. Now, once it becomes a big shareholding company, on us passing on, then the college will be there. Will be there. That is why you get like Staré boys. I mean, even after Griffins died, it's still going. Of course, not the same, but it's still going on. Look at, for example, Strathmore. All right, they have in this case here a very robust succession planning model. But most of these private businesses, even if they are listed, most of them do not have a succession plan. Yeah, and it's purely African, really. Like in this particular room here, do we have anybody who has already written a will that should I die today, I would want my blah, blah, blah to go to blah, blah, blah? Perhaps nobody. Because it's an African to foresee death. It's an African. So fine, that's your password. But for your company, you shall always have that. Should I go today, who takes over? And you shall start this succession planning when you're still strong. So board composition. So this addresses the structure and renewal of the board. So nomination, we shall always have nomination committee, should be in place to appoint directors and committee members. There should be an annual re-election of all directors to ensure accountability and sustained what-year performance, just like these circles. You normally see directors, ladies and gentlemen, putting themselves up for what-year for appointment. Yeah, they are voted for or voted out. The chairman's tenure should be limited to a maximum of 9 years. Yeah, like this board thing at RCM, we started last year. It's still not very, very clear. Yeah, we are trying to have this board charter. Actually, somebody is working on our board charter as we speak. Yeah, so if I'm the one, of course, who is going to be the chairman, then again, I cannot be the principal. Those are the things we're looking at. Because principal at a college level, that is a CEO. All right. So I'll have to choose one because we would want chairman's role and the CEO's role to be separated, to be segregated, to be handled by different people. So I'll have to choose one. Do I want the chairman? Do I want, in this case, the principal's role? All right. And then if it is a chairman, it shall be a maximum of 9 years. Maximum of 9 years. Because I mean, what is it that you would want to do after 9 years that you will not have done? After 9 years are over, get out of that role. Director evaluations should be conducted regularly, annually, internally, or by internal audit or another board committee, at least once every 3 years by an external evaluator, such as an independent consultant. Like you've been given this by like 2 or 3 firms. Yeah, these listed firms where you simply are told, come and evaluate the performance of our directors. These measures ensure that directors remain effective, independent, and aligned with company's goals. So we have looked so far at two pillars and we're almost finishing. You can see I'm almost on the last page. Ladies and gentlemen, number one, the first pillar is board. There must be a board at the top. And then there must be board composition, evaluation, and succession. Yeah. So like this board composition, we expect to have more independent directors than executive directors. So assuming like at RCM, we are 3 executive directors. Executive means what here? That you are here at the school to run the day-to-day. Then we should be able to appoint like 4 independent directors who now will only be coming to the school during board meetings. So board composition, we must be able to evaluate, and then the concept of succession must always be there. Great. Yeah, I'll be able to share the document. Yes, I'll be able to share the document. Now, ladies and gentlemen, the third pillar is division of responsibilities. Key expectations under this pillar: at least 50% of board members should be non-executive directors. Those who are not working in the firm, providing experience and independence. The role of the chairman and CEO must be separated. One individual must not occupy both positions. Example, Enron's failure in corporate governance was partly due to the same person being both the CEO and chairman, leading to manipulation and lack of oversight. Ladies and gentlemen, why do we want to have these non-executive independent directors? It's because of oversight. Yeah, it's because of oversight. Yeah, would want in this case here an independent body that will be oversighting, looking at what these executive directors are able to do on a day-to-day basis. Of course, it'll not be like day-to-day, but I mean, they'll be looking at the documents, and of course, they'll be aiding like in evaluations of the board performance, etc. All right. So those key responsibilities, we want in this case here to like segregate, have an executive directors, segregate. The chairman and the CEO role should be carried out by 2 different people, so that the chairman now will be like the oversighting. Yeah, like that. Otherwise, when you give one individual the chairman and the CEO roles, this person will have what we call unfettered power, too much power in the organization. And as I started these classes, I told you that generally people are greedy. People are very greedy. When you give them too much powers, then automatically they will end up defeating the internal control systems of the company, and they shall steal. Just like the case of Enron. Enron used to be a very, very big firm in the US, which collapsed in 2001. Enron, E-N-R-O-N. Yeah, huge firm. $60 million in those days, worth of a firm. So in this case here, the directors decided, hey, you know, this abrupt growth. So they decided to do what? So these directors, ladies and gentlemen, decided to look at how do we make even more? Despite we have a lot, but we want to make more. They started opening what we call special purpose vehicles, like subsidiaries. So these subsidiaries, whenever Enron incurred a liability, that liability will not be reported under Enron's financial statements. The liability was being taken to the subsidiary. Yeah, a different company, but related. Yeah. So at the end of the day, they were able to show like they had lots of assets, but little liabilities. So using now this very healthy balance sheet, they started borrowing all over, getting more capital, like that. Now banks were very interested. Even when they were listing their shares, people were really interested with their shares because of what are their asset base and little liability. Their net assets were huge. So, and remember who was helping them to do all this window dressing? It is the fifth audit firm, what we used to call Arthur and Anderson AA. Remember, initially they used to be big five, but now they are big four. So this fifth one disappeared from the radar because of Enron's case. They helped Enron's directors to do manipulated accounts. And remember, Enron now reached a point, despite it being very, very massive, what happened at the end of the day? They were not able to pay salaries. They were not able to honor their obligations. Within no time, it was an international news company. It collapsed like that. Locally, Kenya here, we have CMC. Those of you who are a little bit old, you know what CMC used to do: motor vehicles, leasing to government, selling to government. I mean, it used to be a very big company until the directors started to form those special purpose vehicles in Southern Sudan. New companies over there. And then they would import vehicles using those companies in Sudan. And then the Sudan company would now sell vehicles imported by them to CMC Kenya at a very high price. And then the profit, which was now being created, they're creating profits in Sudan. So in this case here, those profits, ladies and gentlemen, they would only do what here? They would only share those profits. Within no time, the big CMC was on its knees. It could no longer be able to pay its obligations. And that is why directors' integrity is key. First of all, getting to know that you don't have a lot of life on earth. They don't need a lot of money to survive well. That even if you were to steal billions and billions, build, in this case here, very big masonettes, at the end of the day, you can't sleep in 2 bedrooms at the same time. Yeah. What they call vanity. All right. So it will be very, very important, ladies and gentlemen, when we talk about this Enron's case. Enron, in this case here, used to be a big company, but it collapsed simply because of what your corporate governance. And one of the issues under corporate governance is that the CEO was also the chairman. So one person had excess powers in the company, leading to manipulation and lack of what year oversight. And also they never had a serious board. Then we have, ladies and gentlemen, the fourth pillar of corporate governance. You must always look at the risks: risk management, internal control, and audit. This pillar focuses on internal oversight. Companies must have a risk committee responsible for risk assessment. Internal controls must be established and maintained by the directors. Both internal and external audits must be carried out. If you're here and you're working for an organization that doesn't have internal auditors, please take this message to your directors. They need internal auditors. And remember, internal auditing is something that you can also do what here? Outsource. So for example, Aura and company, we are doing internal auditing for various firms. One of them being the University of Nairobi Pension Fund. We are their internal auditors. Yeah, we are the internal auditors. So you don't have to have it like an in-house function. You can outsource it to us, all right? And only be coming there like on a quarterly basis. We look at your financial reporting system. We look at, for example, your internal control system, and then we are able to advise. And then the most important thing, once you take us as your internal auditors, then we shall be able to work closely with your external auditors to ensure that you get a good report. Not that we'll bribe them, no. If you follow what we are telling you, we can assure you like 100%, you'll get a qualified audit report. If you follow, because we'll be giving you, instructions here. We'll be telling you, here you are doing good, here we need to do this. This IFRS has not been followed very well. There is an internal control weakness here. Let's strengthen the map, etc. So the very last one, ladies and gentlemen, here is remuneration. So remuneration, directors are not coming to work for free. No, they must be reasonably compensated. Remuneration should be fair and aligned with performance. not excessive. Remuneration committee oversees pay policies. There should be proper alignment between executive and non-executive directors' pay. The goal is to ensure directors are motivated and not under pressure, allowing them to fulfill their responsibilities effectively. So remuneration, we did a remuneration committee. This remuneration shall be pegged on performance. Let people in this case here know that as directors, we have this target that our revenues must increase by 10%. If it increases, how much shall we earn? Don't become a bother to this small organization by taking lots of money out of it. All right. Now, from there, ladies and gentlemen, we go to audit committee, which happens to be my last section for today. So audit committee, a crucial board committee, particularly for listed companies, it is mandatory. Mandatory. Composition, it must have at the minimum 3 members. 3 members at the very minimum. Audit committee, which is a committee of the board. You see the entire board, you choose a minimum of 3 to join what we call audit committee. At least 2 must be independent, non-executive directors. So at least 2 for oversight. Out of the 3, the 2 will be what here? Independent, non-executive. They're not working in the firm for proper oversight. Key roles and responsibilities, they shall be the ones appointing, oversight, and dismissal of external what here? Auditors. Now, ladies and gentlemen, remember the key role of appointing auditors lies with who? With the shareholders. But you see, the shareholders are many. They can't just wake up like this. They say, want to work with the 𝐿𝐿 & Co. No. At least somebody must tell them that these are the firms you guys can consider. And that's why we are saying that the audit committee will be able to play a role in that process. So they appoint, remove, and remunerate what here? External. They are involved. All right? They are involved in these steps. They review audit reports before they are presented to shareholders because the external auditor will really be closely working with the audit committee. Oversight of internal controls and the internal audit function. Ensure internal control systems are established. That's audit committee. Supervise internal audit functions. Great. 3. Oversight of whistleblowing and independent reporting channels. Yeah. Provides an anonymous reporting platform, whistleblowing, for unethical conduct within the company. Yeah, whistleblowing. If somebody thinks things are wrong, they can trust you as the audit chairman, as the audit committee chairman, to simply give you that information, and you don't, in this case, disclose who gave you the information. Proper channels of whistleblowing. Review of financial statements, provide oversight on accuracy and integrity of financial reporting. Benefits of why do you need this audit committee? It enhances corporate credibility and transparency. Build stakeholder confidence. When you hear that a company has got audit committee, we'll always have confidence in that company, especially among shareholders. Provides independent oversight as members are typically non-executive and impartial. Supports a robust control environment and a strong governance culture. Strong governance culture. So, ladies and gentlemen, that is it. I would want to take this opportunity to welcome all of you to join RCM College for ACCA for CPA. This is our number, 0719 525 000. If you are outside there, of course, ACCA, we are known outside there. You replace this 0 with +254. +254. So it has been a privilege talking to you this morning, ladies and gentlemen, and it's my hope that you guys have been able to understand what I've been talking about. So I'll be going to lesson number 4. Thank you so much.